Welcome to the second episode of the OCC's Financial Health Vital Signs discussion series. We're having this discussion series to focus on financial health, and by doing that, to improve outcomes for communities and for consumers. Today, we've got two great guests, Leigh Phillips and Marietta Rodriguez, and we're going to be focusing on assets and asset building. And maybe I can start with Leigh, if you can just give us a little bit of background on you and SaverLife and how you got to that.
Well, first off, I want to say thank you so much for having us. It's an honor to be here with you. And someone asked me recently what I was excited about, and this conversation was one of the things I said I was excited about because it's so wonderful to have this conversation focused on outcomes, right? To have a meaningful conversation about how our financial sector can help improve the financial health of working families in this country. So I'll start with that. So I am the CEO of SaverLife. We are a nonprofit financial technology and advocacy organization, and we are focused on improving the financial health and financial stability of Americans living with low incomes. So we do that in a number of ways. So we are, as I mentioned, we're a fintech, so we're a digital platform. Anyone can join, SaverLife.org, or on our newly launched mobile app. And when you sign up for SaverLife, we're really focused on recognizing and rewarding the positive financial actions that people take every day. So you can earn points and prizes for saving money, hoping to make saving more engaging, hopefully fun. We provide a lot of timely, relevant financial content so people have the information they need to make informed decisions about their lives. We refer people to supportive products and services. That could be government benefits, that could be discounted broadband, that could be credit counseling or private sector products to reduce costs of consumption. But one of the things I think we do that's really unique is to focus on our SaverLife community. So people share their stories, they share their data, they engage in forums and talk with each other. And then we engage our members in our systems change work, in our research and our policy. So we're looking at this issue of financial stability and financial health from two angles. One is, how do we help individual people today to achieve their goals? But the other is, how can we really identify why it's so hard for so many people to get ahead and stay ahead? And that's largely these deeply rooted and entrenched systemic issues that we're engaging our members in the conversation.
And that's great, because I think that's what we really want to focus on today, is this some of those barriers to these kind of longer term and more persistent problems.
That's right.
Okay. Marietta, can you give us a little bit of background on
Sure.
NeighborWorks?
Again, thank you for elevating this topic. It's critically important. I am the CEO of NeighborWorks America. We are a congressionally chartered public nonprofit. We do a variety of things, but we support a network of locally based nonprofits throughout the country. There are 247 of those. We're in every state of the union, including the District of Columbia and the island of Puerto Rico. And we believe in investing both in that nonprofit infrastructure that is providing critical services to stabilize families and communities financially and through their housing. But we also invest in services and individuals that those organizations offer in their communities. Just to give you a little bit of context, our organizations work to provide affordable housing. Last year, they helped create over 18,000 new homeowners, and financial stability is so closely tied with stable housing. I think the pandemic really proved that to us. People were working from home, educating their children from home, but if they weren't stably housed, they really saw their lives sort of unravel. Our organizations also own and manage over 200. Our organizations own and manage over 200,000 affordable rental units. So we work on both sides of that spectrum. We also provide housing counseling and financial capability and financial coaching. Last year, our organization saw over 100,000 families and individuals. We also support 80 community development financial institutions that I think provide some important services for both small business and individuals. So I think that what's so critical about this conversation about financial health outcomes is it's focusing on the individual and how they see stability. And in financial coaching, we really focus on the individual. What does that individual want to achieve, and how can we help facilitate that? And I think that's a really important piece of this conversation.
Yeah. One of the frustrations, it's a frustration born out of the fact that there's just a really significant set of challenges that are out there. And often we look at that through the lens of like a product or a service or a demographic.
Yes.
And I think sometimes it can get lost as to, well, what is the objective function that we're trying to drive towards? Because if we had just a bit more shared clarity on that, that can help us kind of work through some of these trade-off issues and just enrich the discussion a bit more. I see you both nodding your heads. So I don't know if you want to just kind of, it sounds like within your own experiences, are there things, perspectives or thoughts you can kind of add to that?
Yeah, so I think we live in a financial system that is not designed with the needs of people with low incomes or low wealth people at the center, right? Like our system is very much designed for people who have consistency in their income. Most bills are always due on the same day of the month. We assume that people get paid on the same day of the week. And the financial lives of our members and the clients that NeighborWorks serve are very complex, right? So our clients, I'll tell you a little bit about them. Over the last 5 years, we've reached almost 600,000 people across the United States. Most of our clients are working mothers, earning around $30,000 a year, mostly hourly wage workers and mostly renters. And they have a lot of volatility in their income. So when we ask our members, what are your biggest barriers to wealth building? Insufficient, inconsistent income is number one. High cost of living, particularly housing, close behind. So when we really look at how we're designing this system, we're not really designing it for the lived experiences, the circumstances of the people that we're most interested in helping. And I think that that's a big issue, right? Like when we look at it from that perspective. So how do we put people at the center? How do we understand more about their lives? For our clients, you may be making some of your income from an hourly wage job, some of it from gig work, some of it from entrepreneurship, some of it from public benefits and supports. And our system's not really doing a good job of reflecting and supporting people. And then also people have different goals, right? They have different circumstances, different goals, different behaviors, different attitudes towards money. And so for us, we invested and made this big pivot towards technology because we thought that it could help personalize experiences and really kind of deliver different experiences for people based on what they want to achieve.
Do you have, are there instances where financial institutions, banks, lenders, others, have a better connection to that lived? I really like the way you put that, is that the people live their lives in a particular way, and if the system they're operating in is structured not to meet that, those frictions, they have to bear the burden of that.
Right.
And we see that, I know we've seen that with overdrafts, we see that in all these other instances, but are there institutions that do this well, that kind of approach this? Or maybe, are there some stories, are there success stories you can share with us?
Yeah, I think that's a really important point. Like, how are financial institutions showing up in the community, right? And I think about presence. How are they showing up and offering their services, and how are they partnering? I think there are structures that are institutional in this country that make it very difficult for the customer that Leigh just talked about to access those products. But they're regulated and they're safer products than some other fringe products. And so I think that though our financial institutions need to be incentivized to partner with community groups, to make those products more accessible. But you're absolutely right. If it's not someone's lived experience, that plays a huge part in financial behaviors. And how do we change the narrative for all people? I mean, it's not unusual for a high wealth individual to seek out a financial planner, for example. That's not an unusual thing. we have to normalize that for everyone.
Right.
And they may not go to a financial planner, but they might go to a nonprofit housing counselor or a financial capability coach. But oftentimes we drive people to those resources that exist in the community at times of crisis.
Yeah.
We did that in the 2008 foreclosure crisis. We did it in the pandemic. And I'm not saying those aren't bad drivers, but if organizations can build and these institutions can build on those relationships, then we can take you from a point of crisis to other safer financial products and services in the community that can help them achieve the goals that they want to achieve.
Yeah.
And so I think it's about presence and how institutions are positioned, how they partner, and then ultimately, obviously, they need to offer a responsive set of products and services.
Right.
But often that's where we start, is with products and
that's right.
services.
That's right.
And we don't think about accessibility, we don't talk about presence, we don't talk about partnership with the same vigor.
Right. It's almost like the order of operations is switched, right?
Well, yeah, exactly. I completely agree with that. And I think what we've been doing in the past is looking at how can we change people, right? Like how can we educate people
Right.
to operate in this system that was never really designed for them to be successful in the first place. And I think if you flip that and you think about what does the system look like that supports people and helps them to achieve their dreams, to build stability and wealth. And to Marietta's point, for most Americans, paid financial advice is really out of reach. So your banker, your credit union, that's who you've got, right? Like those are the people that you need to be on your side. And I think there's a couple of trends that we've seen recently that are interesting. So over the course of the pandemic, we saw the utility of banking really increase for people, right?
Yep.
So we talk about access. So access is one point, but how useful is that product really to you? And during the pandemic, when everything was, things had shifted online, and there was, stimulus payments and unemployment insurance and child tax credit payments and all these things, people suddenly we're like, oh, well, if I have direct deposit, I can get access to these funds faster. So we've seen those kind of numbers of unbanked people really, really drop. But I think the question that we're really engaged in today is the big question.
Now what?
It's the so what question, right?
Yeah.
So, okay, so you got an account. Well, are you better off financially? And how do we really look at that? And how do we measure that? And we've also seen now, our financial system is largely driven by technology. So the amount of data and information that we have about people is, exponentially increased from what it was, a few years ago. So how do we really harness that and maybe look at things and say, oh, looks like maybe this fixed date for you to pay this bill isn't going to work for you this month. Maybe we can move that out a couple of days and not charge you a fee. There's all sorts of things, and we're seeing that in the financial technology world, and increasingly, I think, in the mainstream banks and credit unions as well. And I think that's something to be hopefully excited about.
Yeah. I have to, with the other hat I wear is as the director of the FDIC board. And there's a committee called the Committee on Inclusion. And I remember Jen Tesher at the Financial Health Network kind of reporting out and saying, this unbanked number is going to continue to go down. And she was right. There was a meeting before this latest report on the unbanked and underbanked. And sure enough, number comes out and it's at an all-time low, which is great, in large part because of these bankable moments. But it does caution us because I think there's a tendency to maybe pat ourselves on the back and say, like,
Our
great
work
job.
is done.
Right.
Our work is done here.
Right.
Right.
And it's just beginning.
That's
because
correct.
once they're
That's right.
banked, now what? And again, what outcomes do we want to drive towards? And how do we know? How do we know whether those outcomes are good for the people who have who are trying to both provide access and improve their financial health?
How do we know, and how do we build on that bankable moment to encourage mainstream financial institutions to build a positive relationship, right? Because so many times people have a bad experience.
Right.
And then, in recent events, that there's been some question about can we trust banks? And so I think it's, again, how do we incentivize institutions to act differently with that customer?
Yeah.
And I think we're starting to see some of that trend with overdraft fees being taken away. We're also even seeing on the mortgage side an encouragement, if someone has a financial crisis, to automatically go into a workout and forbear versus starting the foreclosure crisis, or starting a foreclosure, because that's very expensive to foreclose. So we're starting to see it more, but I think there's a long way to go. To Leigh's point, how do we flex and create a system that can accommodate all kinds of incomes and economies, not just the traditional biweekly paid employee.
That's right.
Right. I heard once someone referring to the difference between leverage and debt, and saying that if you're a high wealth individual, you want leverage, because the idea is that you have assets that you can leverage, and that's a benefit. Whereas if you're not, then you're basically just in debt, and debt feels more like an anchor around your neck rather than something to help, even though it's the same product. And I think this gets us to this issue of asset building, and how do we build assets to be leveraged, because that's what the financial system can do. And it sounds like you each have different experiences kind of coming into savings, home ownership. Can you just talk a little bit about either your experiences, your stories, just in the asset building space?
So SaverLife has actually been a nonprofit for over 20 years. We originally came out of the asset building IDA world. We were EARN for many years and provided IDAs to help people buy homes, start businesses, and get a post-secondary education. And we were pretty successful. This predates my time at the organization, but we were pretty successful at doing that. One of the largest IDA providers in the country. And in our first decade, we helped about 6,000 people achieve those big goals, which was great. But half of America or more is living paycheck to paycheck. So for the organization, really took a look at, well, what can we do to stand up a more scalable solution, a more flexible solution, and how can we look at some of the root cause issues within the financial sector of what's causing or what's preventing people from achieving these goals. And we can tell you that it's not lack of knowledge, it's not lack of discipline, it's not these are all myths that we really need to dispel, right? These are deep systemic issues, and how we look at those is incredibly important. So one of the things that we learned through all these years of helping people save is that people can save, they do save, they will save. But the number one reason why people got off track in achieving their goals was because of short-term issues with liquidity. Right. And so that's where we made this pivot to say, well, if we can focus on financial stability and really look at if we can increase short-term savings, emergency savings, liquid savings, however you want to describe that, can we create more stability and then keep people on that trajectory? So that's what we've been focused on because we know that it works. We know that people who have, at least amongst our client population, if you have less than $250 in savings, you are 70% more likely to be evicted from your home for a financial reason. And as Marietta started out by saying, housing insecurity and financial insecurity go hand in hand, right? And so that was for us is really looking at people have these financial lives that are very volatile, inconsistency in their income, lack of things like paid family leave. I had to take a day off work. Well, I had to work from home a day this week because one of my kids was sick. That was no problem for me, right? But for other families, they're having to make these trade-offs, right? If I don't go to work today, I don't get paid today, but I don't have another choice. So in the face of those kinds of circumstances and that kind of volatility, savings definitely helps provide a buffer and prevents those cycles of indebtedness that can then come from these interruptions of income or these mismatches between income and expenses.
I think that's 100% spot on. The difference between a leveraged in person, that conversation that between high wealth and low wealth is the ability to weather a financial crisis, right? How small or how large? Do you have assets that can cover you? Do you have access to products? Do you have access to credit that could cover you? And I think I think we need to start changing the narrative there because that short-term gap can throw people into a huge tailspin that could take years to recover from, particularly if it impacts their housing. I remember when I was a housing counselor working with a family, the 3 kids, mother and father owned their own company. They were landscapers, but they only worked 7-8 months out of the year, right? So they needed to be able to save money to see them through the winter. And their lived experience, they lived in a rural community, they were Native American, and their lived experience, no one in their family had ever had a bank account. So they saved their money literally in a metal money box.
Wow.
And they were incredible savers. But they had all these envelopes, and they would put money in for utilities, the utility envelope, they would put money in for food, and for and that's how they managed. They were an incredibly healthy, financially savvy family, but they never banked. And it wasn't until they came to work with me, and they wanted to buy a home, but they didn't have a credit history. But they had saved in their metal box over $25,000, and like that was a down payment, right? But I first had to like introduce them, like, this is probably not the safest place for you to keep your money. Like, let's start a banking relationship. And it wasn't until that we could start to change that narrative and explore the possibilities. But that began for that family a different lived experience than those parents had had with their family, right? Their children now saw their parents going to the bank. They saw them talk about their mortgage, and just it was a different lived experience.
So that story is very powerful, because I think it really does highlight a point that you've been making, Leigh, that there is this narrative that people just need to be more literate, which is from one perspective, is just a lot of victim shaming, where in fact they're quite literate. The story you're telling, that is more financial savvy than
100%.
99% of the people out there.
100%.
But it's not the lack of literacy there that's the problem. There are some structural issues relating to how banking access and products and services are made available. I remember hearing this story about there was a group that would run a simulation on living paycheck to paycheck, and a colleague, old friend, colleague of mine, would go, and he said, it's the most stressful thing. You go, like, walk into this booth, and they simulate like a week's worth of, balancing your checkbook as you're doing all these things. And he's like, if you were a big bank treasurer, maybe you could do this, right? Because you're keeping track of your inflows and your outflows. But that's how a lot of people just live.
Yeah, every day.
And every day. And they've got a set of tools that are not well suited to that. So then the question is, well, what can we do to make those tools more well suited, both in terms of either tool design, information, partnerships with banks, regulators? What's on your guys' wish list in terms of thinking, ambitiously about how to address this?
Yeah, well, I've been thinking about this a lot, obviously, in preparation for this conversation, but also just, in general, because if you're looking at the root cause issues here are pretty complex and wide-ranging, right? So, we know that people have inconsistent work schedules. We know that people aren't making enough money at their jobs. We know that millions of Americans lack medical insurance, paid sick leave, like all of the things that provide stability to families like mine, millions of people in this country just don't have, right? And so then we come back to this question of like, well, what's the responsibility then of the financial sector, the financial system there? And so I think, first off, having this conversation and thinking about, let's look at outcomes, right? Like, let's look and try and, maybe this is overly simplistic, but if our North Star becomes our families in America, households in America doing better because of certain financial products and services, or are they doing worse? And we're seeing a lot of new products and services enter the market right now, right, in the financial technology world, and some of those are good, and some of them maybe not. Some of them we don't know yet, right? But the only way that we can kind of keep up with this is to put that kind of overly simplistic lens on it and say, well, does this product help someone or does it hurt someone? And in what ways? And so I think for us, we're really looking at understanding people, understanding the complexities of their lives, and designing for people with that in mind. And so, as I mentioned before, we're seeing this increase of flow of data and information that we have about people, that we can maybe make changes, relatively simple ones. I mean, Marietta mentioned overdraft and how many banks have now decided to do away with overdraft. And that's great, right? That's the kind of positive change that we want to see. But the next question for us becomes, well, people do save money, right? So in the SaverLife community, people are saving thousands of dollars, right, every year, but they're not gaining wealth, right? So we have this kind of saving for soon situation where people are hedging against future volatility. So how do we transform that positive financial behavior and steps that people are making and ensure that actually leads to people gaining ground. And so I think starting with looking at where is the financial system stripping wealth from people, where is it accelerating wealth for people, and how can our financial system be partners to our communities and to our individual households on that journey towards wealth building.
I would agree completely. I love the question and thinking about what's our moonshot like. If we're really gonna, what does that look like? I think there's a tremendous opportunity in the financial sector right now. I think we're in a little bit of an inflection point. There's a lot of conversation about how to serve communities, how to perhaps close the racial wealth gap in America. And there's a lot of conversation about it, but we need to start doing things and start trying things. I know some financial institutions have started utilizing their special purpose grant programs. Let's make that bigger. We know with rising interest rates, down payment assistance is critical. Closing cost assistance is critical. Let's start investing in let's start investing in a national down payment assistance pool. And not everyone is ripe for homeownership, but what are the gaps that our mainstream financial institutions aren't filling? And there are CDFIs and other groups that can partner that can do that. I think about our organization in New York City. They work in Chinatown, and during the pandemic, they went out and just talked to people, and they found small business owners that were worried about losing their businesses during the pandemic. There was a very small ramen shop that was very worried, and they had a CDFI that lent them money through the pandemic, and it enabled them to sort of pivot to online ordering and delivery. That shop grew so much during the pandemic. They grew out of the ability to access money from that CDFI. They had to go to a mainstream bank. They moved into a new location. I mean, it was just, but they would have never started that growth trajectory but for that outreach. So it may not be the role of a big bank to do that, but is the big bank investing in those community infrastructures that enable that kind of growth that can move community assets in the right way? I think that's the question. What are those gaps, and where can we strategically place those kinds of investments in both people, but also in institutions and infrastructures? So,
the small business story is interesting because I think it does start to speak to this question on the diversity of the banking system. Because often when we talk about financial inclusion, products and services, overdrafts, for instance, everyone immediately thinks of the big banks because they impact a lot of people in terms of the sheer numbers. But when you're talking about, your example, the ramen shop, that's not a big bank loan probably, right? That's going to be a CDFI, that's going to be a local bank. And
a community bank, right.
Community bank. Folks where relationships are pretty important, right? They tend to outweigh just a pure transactional view on things. And I'm curious if you guys have any stories about how we can best promote that, because as a regulator, we at the OCC, we've got the largest banks, we've got the mega banks that we supervise. We also have 800-900 community banks under $1 billion that are also part of this conversation, that need to be part of this conversation. And I don't know if you have any thoughts or wisdom.
I don't know if I'd call it wisdom, but I think that providing leadership and encouraging those smaller banks, regional banks, local banks to really think about their community and what kind of customers are they not seeing, and why is that? Really being sort of self-reflective in that. I mean, I was talking. It was a large bank who was trying to build their mortgage business, and they were saying, we have trouble even getting to our own customers on mortgage, and it's like, because I don't think that people see you as a mortgage lender. So, but you need to sort of get some input and be self-reflective to think about that. So I think it's really encouraging the financial institution to look at the community and seek feedback, and what are the gaps, and what do people think, and that can sometimes be difficult to hear. But I think that if the regulator or others was really championing, let's identify what we're doing right, but also what we're not doing, and then get a shared vision around that and build some momentum to close those gaps, I think that would be really helpful.
I think that makes a ton of sense because, what are we really talking about here, right? That we're talking about what are we trying to achieve together? What is our sense of shared purpose? And I believe that, there are many wonderful people that work in the financial sector who really believe that in helping people and wanting, primarily want to help people achieve their goals. So what are we trying to achieve together and how will we know if we've achieved it? I kind of think is somewhat at the heart of the question. And so when people join SaverLife, they link their bank account to SaverLife, right? So we use a data aggregation service to connect people's savings accounts. And I can tell you that 80% of our clients bank at one of 30 financial institutions. Wow. The other 20% bank at one of 3,600 financial institutions, right? So that's
amazing.
It's a pretty long tail.
Yeah.
Wow.
Yeah. So first off, you can't not look at the big guys, right?
Yeah.
Because that's where most Americans are doing business, including our clients, and that includes big credit unions, includes some of the new neobanks and products and services like that. But we also have to make sure that the 20% of people who are banking at maybe smaller community banks, credit unions, et cetera, that they also don't get left behind. And so, up until recently, I had the opportunity to participate in the CFPB's advisory board. And that's a big conversation, right, around access to people's data, how we fuel financial services. All of that kind of rulemaking is going to be really pivotal, but we have to do it in a way that first off centers financial inclusion, right? Acknowledges that inclusion is not enough, right? Like inclusion in an imperfect system is not really going to get us where we need to be, but that we don't leave financial institutions behind either in this kind of tech revolution. So that's going on. And so I think those are the things that we're really kind of keeping an eye on. And then looking at what our clients are doing. Where are they taking their dollars? Where are they banking? What kind of products and services have they identified that are working, for them and for their lives? And that could be, that can look very, very different depending on what you're trying to achieve.
Or not. What are they not doing and availing themselves to? Yeah.
So I think part of this may be linguistic. So in the sense that a lot of institutions will talk about financial inclusion, and often I think that's a euphemism for just getting more market share, or users for a particular product or service. And what I'm hearing both of you say is that you have to flip the whole thing around. There are people out there who have a particular set of needs, they live a particular life, and they need something for how they live. And that's kind of the starting point for this discussion, and then just getting them, and then that, I think everything flows from that. Just getting the bank account isn't quite enough, right? That helps, but then you have to include all these other aspects to say, okay, if you're making your income in 9 months of the year, what kind of products and services can really help enable you to not just meet the payments as they come due, but then to start putting that money away to basically building wealth, building assets that can be leveraged in the future.
Right. And a bricks and mortar location in a low-income census tract is only one step, right? If people don't feel welcome once they walk in that door, right? So it's inclusion, but it's really more, are you accessible? Are there responsive, accessible services and products.
Right, that are useful, that are useful to you. And I also think, sometimes we're talking about relatively small amounts of money that can, to Marietta's earlier point, really set people on in a kind of downward trajectory. So how can we really help with some of these issues? We have one of our clients had saved an emergency fund with SaverLife, and then her son was taken ill, had to be in the hospital, and she had to miss a week of work, and was able to fall back on that emergency fund, which was great, and not go into debt, not fall behind on rent, all these other things. But there's millions of people who don't have that, right? And so in that case, we're talking about a couple $100. And so these relatively small amounts of money can be pretty meaningful for people. And I think that we need to be more creative, right? Ask the question differently, not what are the products and services, but what is it that people need, and how can we serve people better so that they stay on a wealth building trajectory.
So that last bit I think is really important to bear in mind. So Aaron Klein at Brookings, he does a lot of research in this particular space, and he calls it a regressive, like a reverse Robin Hood system. The more wealthy you are, the more freebies you get.
That's
You get all these free services because that wealth, they can kind of earn a bank can earn its money in a different way. Whereas, the more vulnerable you are, the more expensive these things are.
Yes, that's correct.
And every dollar matters more as a percentage in terms of kind of meaning impact
that's
on
absolutely
their life. And so kind of trying to change that mindset a bit is an important part of the conversation.
Right, and that's why when we have to change the conversation around, it's not about lack of discipline, it's not about lack of knowledge, it's not about rates of consumption, it's largely about costs of consumption.
Right.
People paying more, paying too much for the things that they need,
Right.
not the, make your coffee at home phenomenon, but the,
Right.
like you missed a week of work, or, for valid reasons, or your employer didn't give you enough hours that,
Right.
that you were expecting, or you're self-employed and your income is volatile. And so these are, largely systemic issues that people are facing every day that we really need to think about how we can work together within the financial community to overcome.
So as we wrap up, are there last thoughts or questions or ideas, stories that you'd like to kind of share with folks?
I mean, I think these issues, as complex as they are, I don't want to diminish the complexity, but I think that we have the ability to solve these problems, right? And there's just a matter of, can we align will with resources? And I think we could go a very long way, and there's to solving some of these issues. These are not unsurmountable.
Right.
One of the things that, Leigh, you said in an early preparatory conversation was that if we were going to design a financial system to serve most Americans, it probably wouldn't be the one that we're currently functioning in. And I thought that was absolutely true. It's probably true for a lot of our systems, healthcare and other things. But I think if we can be honest with ourselves about what we can do and align resources to that vision, I think we could solve a lot of these problems.
I think that's right, and that's a really powerful and positive way of looking at it. So when we ask our clients, what is it that you most want to achieve, the first thing people will say is, I want to sleep well at night.
Yeah.
Right? I mean, and I think we can all relate to that.
Yeah.
I want to sleep well at night, and I want my kids to have a better life.
Yeah.
Right? Those are the two things that people say most frequently. I want to invest in my children. I want to invest in my children's education. I want a safe and affordable home and a place to raise my family. So home ownership, it remains the number one, long-term goal for most of our clients. But the short-term goal is, I just want to sleep well at night.
Yeah.
And I think that we need to solve this problem because, we cannot continue to live in an economy where anywhere between 50% and 2/3 of the people don't sleep well at night, right? Because they're living paycheck to paycheck and they don't have the opportunities to build wealth and to get ahead that we know we have the ingenuity and the tools now to deliver on.
Right. And I like how this conversation is ending in the sense of shared purpose, like focusing on those things that really matter, and trying to come at it a little bit differently. I think we are going to have more of an outcomes focused.
Yes.
Meeting people where they are, not trying to kind of do it through a particular product service lines, and then working collaboratively to kind of align resources and will. I think that's that's something that we at the OCC we take very seriously. And we've got lots of initiatives. We got some tricks up our sleeve, which we'll be working on in the future. This has been a great conversation. Just really appreciate.
Well, thank you for elevating this conversation and your leadership on this issue.
It's incredibly important.
It's super important, and thank you guys for your dedication on this issue for many years and bringing your experiences and your perspective to Vital Signs.
Well, thanks for having us.
Great.
Great. Thanks.
Thank you.